Well, thank you, Andy. Thank you, Corinne, and other members of the organizing team. It's my great pleasure to be with you, and I'm just very impressed with the crowd, the commitment, and the lack of empty chairs. So I hope I don't disappoint you. I'm going to draw together two different issues which have been an important part of my life. One is the research to which Andy was referring, and the other one is the work that I've done with long-term investors to take those research ideas and put them into practice. So what I'd like to do is to start off by giving you a sense of the data that I and my colleagues have compiled over a remarkably long period, but the period that we cover the data for is longer still. We have data that goes back to the year, as Andy was saying, to the year 1900. We have data on the annual returns on stocks, on government bonds, on treasury bills, on inflation rates, on exchange rates, and on economic growth over that 123 years. Altogether, we have data covering that long period of often a century or more, and for at least half a century, for 35 of the Dimson, Marsh, Staunton markets. These are the markets where, over the years, we've been able to assemble suitable data. They're marked in dark blue. 23 of those start in 1900, and there's another 12 which have a later start, but which we still regard as being useful for guiding us about history and the future. So there's those 12 that start a bit later, and then there's 55 more markets for which we have equity market data, but not necessarily the full array of data that we would like to use, and there are some that are simply not covered. Altogether, we have 90 countries in total for 123 years, and we have 5 composite indices. These are indices in common currency, such as Europe or the world. So how has this market evolved? Our data set starts in 1900. You might think that the United States would be the biggest. The vertical axis shows you the share of the global stock market, and the horizontal axis runs from 1900, 1901, and so forth through to the beginning of this calendar year. And so you can see that although the USA was quite big, other markets, Great Britain, Germany, France, were comparable. But as time proceeded, the United States was very successful, and apart from a dip, which is about 3/4 of the way from the left to the right of the screen, the United States was bigger than other markets. The exception was the brief period in which Japan came to be the largest stock market in the world. So the UK was the biggest market back in 1900, but it was overtaken by the United States. And we have data on all of these markets. For a couple of them, you will see them color-coded on the left, such as Russia, and they are, if you were to look very closely, color-coded on the right, but there's a gap in the middle, and the same is true for China for reasons which we understand. Let me have a look at one of them. The country I'm going to choose to look at in more detail is Switzerland. And so you can see here what the performance was of the main asset categories in real terms. Almost all the data that I'll show you is adjusted for inflation. That's what we mean when we say real terms. If you had, back in New Year 1900, bought equities in the stock market in Switzerland, that would have grown in real terms to having a purchasing power that's 231.8 times as big as the money that you put in at the beginning. The cause of that? Mostly it's the income that's been generated and paid out by way of dividends, and some of it is capital appreciation. If you had put your money instead into government bonds, again, reinvesting the income back in the bond, and we assume reinvestment is costless for both equities and bonds to construct an index the way that people in the index business usually do, your money, your investment of 1 Swiss franc back in 1900 would have grown to 11.7 times as much in purchasing power. Treasury bills would have simply doubled your value. In other words, the income that you would have got from cash was modest. So in Switzerland, equities beat government bonds, and government bonds in turn beat treasury bills. And so it's helpful perhaps to look at Switzerland as an exemplary country and then draw a comparison with other countries. So if we look, first of all, at the annualized real inflation-adjusted returns and risk premiums, what you'll see is that over the last 20 on the left, middle, 50 to the right, 123 years, looking at the tall bar, the middling bar, and the smallest bar, which is treasury bills, you can see the real return that you would have got from those assets. And we can also compare equities to risk-free investment, putting money with the government. And so equities are best over those periods. If we look at the equity premium, that is the difference between the equity return and either bonds, which shows up here in a strong blue, or in light blue, the equity premium measured relative to treasury bills, or the maturity premium, just out of interest, which is the navy-colored bar, you can see that there was a handsome equity premium, that equities in Switzerland did much better than putting money into notionally risk-free alternatives. So what I'd like to do is to look at that Swiss example and examine this for a different set of countries, so that as well as Switzerland, we look at others. What I've got here is a set of bar charts which show you the return after inflation in common currency. So here we've moved into US dollars as our common currency for a range of different countries. Only the people in the front will see which countries there are, but I'll point out a few of the indices. First of all, I'll wave a flag over what the CHE, so those in the front row can see that there's your country, and on the extreme left we've got Austria, and on the extreme right we've got Australia. The abbreviations are similar, but the performances were remarkably different. And then I've highlighted in yellow 3 markets where we're looking in common currency, but at a composite index. So over here, the yellow one in the middle, you won't be able to see it from the back. It says WLD. That's short for the World Index, market capitalization weighted. Then you can see WXU, World, excluding the United States. And over here, towards the right, the USA. So you can see those different levels of performance. And what we can do is look at the historical performance of equities compared to the performance of government securities. So there's government bonds. Government bonds usually gave you a positive real return, but not everywhere. But they were all worse than equities. And then you can see treasury bills, which were generally a disappointment, even compared to government bonds. So on the top of the world ex-United States, you can see 4.3%. That is the compound return that you would have got from equities. And you can see beside it the world index, including the United States, giving you 5%. And on the extreme right, you can see the USA. And the gap between the two is what we call the equity risk premium. The gap between the equity return and the bond return is 3.3% compound over 123 years. And if we look at the gap between equity returns and treasury bill returns, you can see that the gap was 4.6%. You'd have got 3 or 4% per year over the long haul, not the same every year, but you would have got a superior return, a large historical equity premium compared to bonds. But maybe that was a lucky century. And so the work that I and colleagues are now working on is also looking at data over even longer periods to see whether that was unusual. But a lucky century, it may have been the United States, which was so big, that was the lucky country. If we look at the United States, it's perhaps informative. I did this chart for an article that's published a couple of years ago. So you can see on the left, you can see a set of bars in blue, and the country which I'm marking here is the United States. It did better than Europe, the world ex-US, Japan, world, or Great Britain. And you can see that over the last 20 years, up to the date where we published, same story. Over the 10 years till then, over the year that we had just finished when I published this, the US had done well as well. So Europe has found it hard to perform as well as the United States. And so it makes you ask, well, maybe it was a lucky country, maybe it was a lucky century for Americans. And so one of the things which we've also been looking at is data which has been compiled by another US academic who has looked at the performance of stocks and bonds on the right-hand side of this chart from 1900 going forward. So that's very similar to what we had looked at. And on the left from 1800 to 1900. And so he has an article which is accepted for next year's Financial Analyst Journal. That's a trade paper for people like me who work in investment. And so he will have this published. The paper is called Stocks for the Long Run? Sometimes yes, sometimes no. And it is conceivable that the future will be less generous than was the case for the 1900s. Bond yields are also an interesting issue. There's a man called Schmelzing, who's based in Cambridge and Oxford, Harvard, distinguished set of histories. And he's been looking at interest rates over long periods. Interest rates have come right down from extraordinarily high levels. And I just pick out one sentence in his concluding remarks. The evidence, he says, after looking at centuries of data, does not support the view that there will eventually be a return to normalized levels. You are a real estate audience, and so one of the issues that I think is relevant is the long-term performance of real estate. And there's a study which a team led by Yoda has undertaken, which a lot of you must have noticed, which looks at the main asset categories around the world. They look at equities. Equities, on their estimate, have given a long-term return of 6.9% with a volatility of 21. And they look at bonds, 2.5 with a risk of about 11. And then they look at housing, and they contend that housing gives a return that's at least equivalent to the return on equities, but with a very low risk. I find it difficult to intuit this. This is residential housing. You can't put together a globally diversified portfolio of personal homes. Nobody can. So one of the things which we looked at was a comparison between his study and other studies. His study is macro, looking at broad indices going down. There are micro studies which look at detailed records going up over time. And the competing studies, which are the two lower lines on this chart, show you what performance has looked like in terms of income growth over the very long term for a common period, which is available from all three studies. So they reckon that income growth is modest, but in the Yoda et al. Study, it looks large. The remark I'd make is one has to be cautious about reporting returns and interpreting risk in this field in which one looks at multiple assets, of which real estate is an important part. We've also looked at returns in different inflationary conditions, looking at banding the lowest 5% of all 2,000 to 3,000 country years for which we have data, the next 15, and so forth, up to the 5% of country years when inflation was highest. And what we find is that bond returns, when inflation is very low or negative, have been handsome, and when inflation has been high, has been low. But in all of those cases, the performance of equities has been affected by inflation. But if you look on the right-hand side, though inflation hurt the equity market, the performance was much better than it was for bonds. And you find that all the way through, except in the cases of extreme deflation on the very left of the chart. So let me talk a little bit about stagflation and the impact of inflation and economic growth. We've looked at all of our data. We have several thousand different years and country combinations. we've broken them down into the countries that had the lowest GDP growth, the third of countries with middling growth, and the third with the highest growth. And then we've looked within those at the countries with the highest inflation, middling inflation, or low inflation. Stagflation is where inflation is high and economic growth is low. There's a middling group, and the high group is where there's high economic growth and low inflation. And you can see from those bars that the equities, which are the navy blue bars, have performed particularly well in those conditions. So investors are right to worry about growth being poor and inflation being high. We've looked using our long-term history at the drawdowns from bonds and equities and the impact of blending the two into a diversified portfolio. And you can see on the left the fall in value from a previous high of government bonds or of equities, which have at times lost 2/3, 3/4, or even more of prior real value. And on the right, you can see the impact of having an equity bond mix. So let me take all of that and make some projections into the future. The world since 1950, that's roughly speaking my world. That's the world of the baby boomers. And for the baby boomers, what they have experienced over this period is massive equity returns, poorer bond returns, and a 60-40 blend of 5 or 6% as the annualized real USD return. If we look at the world since 1970 or the world since 1990, we see again 5 to 6% for a stock bond blend. What does the future look like? Well, we know what interest rates look like now, and we can project forward using the equity premium we've created looking historically. So a rough guide would be a halving of the long-term forward-looking returns that we can expect compared to the experiences of the older and less old and even the younger members of yourselves. So where can you learn more about this? This for us started nearly a quarter of a century ago with a book called Triumph of the Optimist that we published. We have an annual update of that. It will have a different logo on it this coming January, but it's been coming out consistently from Credit Suisse. And we did, a few years ago, do a focused booklet on the financial history of Switzerland. Here's the address you'd write to if you want to contact me and get a copy. The book won't be free, but I can help you otherwise. Thank you very much. Sorry about my timing, but...
It's okay, it's totally fine. If you got any questions, please send it through the NZZ Connect app. We often hear the headline, equity prices fall because of weak economic outlook. Your data about the correlation between stock returns and also economic growth, what does it say?
It's a very interesting story. There was a period in which the terminology BRICS became fashionable, and that coincided with the idea that smaller economies might grow fast and would reward the stock market investor. So we brought our data together with GDP information to look at what happens if you buy the stock market of countries where economic growth is poor, middling, or good. And it turns out that buying hopeless basket case economies will make you, in the long run, more money. So the performance of low growth economies is good. High growth economies do not reward you. But low growth economies can also be rather exciting, and whether they're poor performance or the occasional bubble upwards, that's for your personal taste.
We've seen a lot of crises now in the world. We have the Middle East, we have Russia, we have the US and China, this problem. How do geopolitical crises influence like the stock market?
But investors, of course, are looking ahead all the time. And so when you go through a crisis, you will typically find that values fall. But in addition, when people look ahead, they'll be asking themselves about risk in the future. And that may mean that they demand a higher return for the risky future. And to get a higher return, prices have to fall still more. So Russia is the case that we've seen. Middle East, the jury is still out there.
We have a question from the audience. How does your portfolio look like? Interesting question.
My portfolio is highly diversified. So I spent quite a long time chairing the Strategy Council for Norway, and because of the asset manager to whom we delegate, there's almost as many stocks in the portfolio of myself and my wife as there are in the Norwegian Sovereign Wealth Fund.
Everyone is talking about ESG compliant equities could perform better than traditional ones. So what does the data say on that? Is it true or false?
I've done a lot of work in the ESG area. I mean, for Norway, I, together with 4 others, put together the proposals which were eventually passed into law. But one of the things which had also influenced us was what the long-term investment results were for not such nice companies. If we want to look at a very long period, we don't always know whether a company was nice or nasty. So in Britain, for example, oil companies were nice for quite a long period, although they're not now. There are 2 groups which people think are not nice and have done for a very long time. One is alcoholic beverages. Well, I see you are serving some refreshments here. And the other one is tobacco. If we look at alcoholic beverages in Britain, that's the best performing sector of all time. And
not surprising.
Tobacco is the number 2. In the United States, they don't have an alcohol index until after prohibition. But if we choose that common start date, alcoholic beverages were only number 2, and tobacco was the number 1 performing sector. So sin stocks may reward you more. Why would they reward you more? It's because people won't pay as much for them. The price is pushed down below fundamentals.
All right. In conclusion, what are, let's say, the 3 most important principles for being successful in investing?
Well, when we do our research, we talk about global investment. And the reason for that is that diversification is crucially important. So one issue is diversifying both across countries and across asset classes. And so for many institutional investors, the one that is missing is real estate, where there just isn't the same representation. And then I think the second one is probably cost. If you pay high fees, I'm sorry about this, folks, if you pay high fees, your performance after fees will on average be lower. And the other one I think that's important is keeping investment simple. So complicated arrangements are difficult to maintain for the long term. So having a simple approach and a simple organization for the investment organization typically is worthwhile.
Thank you so much, Professor Elroy Dimson.
Thank you very much. Thank you.